Welcome to Takeaways Podcast, the show where we discuss the context behind the technology, personalities, and headlines. On today's show, I'm with Clive Butkow. He's one of South Africa's most experienced voices in technology and venture capital. Clive spent close to 3 decades at Accenture, where he rose to COO before he moved to a full-time role into venture capital. He's the founder of Kalon Venture Partners and the co-founder at Conducive Capital, where he backs the early stage and growth stage technology startups across Mzansi. It's great to finally have you here, man.
No, thanks, Roman. Thanks for the opportunity and welcome.
So to start with, right, you have spent, close to 4 decades across corporate and startup in enterprise technology, in consulting, and now you're in venture capital. You have seen it all, right? Before we really get into the specifics of it, I want to start broad. Where do you think the venture capital is in South Africa at the moment?
Yeah, I think venture capital, when I started in 2013, was probably more cottage industry. It was very small, very small amount of capital. And what ignited that was the Section 12J promulgated by SARS, where people could get 100% deduction on their taxable income. And what that created was a few billion rand going into tech venture capital. And it spawned out quite a few new tech companies because of the tax benefit. Kalon Venture Partners, which is the one that I founded and I was the CEO of, I did resign from there about 2 years ago, was spawned out of Section 12J. So I think if I look at today in 2026 going forward, I think the venture capital industry has matured significantly. I think a lot of the fly-by-night players that entered through the Section 12J environment are gone. They really were fly-by-night. They weren't really venture capitalists. They were taking opportunity and taking advantage of the tax saving. But those companies are gone. I think the good companies that are remaining, and there are quite a few of them, a lot less, but these are really mature companies. They understand venture capital. They're probably investing in later stage VC, like their growth rounds or Series A rounds. But it's very much, venture capital has really become a lot more mature in the last 12 years since I got involved in South Africa.
Whilst we're still on that conversation of what it takes to be able to become, like an impactful VC, can you just expand? Because I imagine that it takes more than just receiving, like a pitch deck from a founder and then in a few weeks you sign a term sheet for them. Can you take me through what it takes to be able to identify companies which are going to return 10 times what you invested in them?
Let me just clarify for the audience, Ephraim. So since I left Kalon Venture Partners 2 years ago, I started Conducive Capital, but we haven't actually raised capital into Conducive Capital. We sort of put a pin in that for the meantime. And what I've done over the last 18 months, 2 years, is I've made 11 angel investments. So not only am I in the venture capital space, I've actually been investing in angel, early stage, post-revenue startups in the last 1.5, 2 years. So the reason I say that is because the criteria I look for, whether I'm an angel investor or whether I'm a venture capitalist investing in a little bit later stage, are pretty much the same. And really what I call it for me is like the 7 C's that I look at in every company and entrepreneur. And number one is, is customer traction. If it's early stage, yes, 10, 20,000 rand a month, but I'm seeing there's customer traction. If it's later stage, maybe 1, 2, 3 million, 4, 5 million rand a month, which is what we would, typically look at for a Series A type of investment. So that's customer traction. The second thing I look at is customer retention. It's all well and good being able to attract customers, but if you're not retaining them, you've got a leaky bucket and they're falling out the bottom. So retention is probably just as important as acquisition or traction of those customers. So I don't like companies, whether it's business to consumer or business to business, where they are actually, they pay you 1 or 2 months and then they're walking away and stop paying you. So that type of thing, that if you don't have that customer retention, it's not something that's, really going to excite me. I think the third C is more around capital efficiency. I want entrepreneurs that respect capital. They respect capital. They understand capital efficiency. It's not just about growth at all costs. Take your money and just spend it and see what happens. It's not what I'm looking for. I'm looking for entrepreneurs that understand capital efficiency, understand if I put $1 in, I'm going to get $2, $3, $4, $5, $10 out. That's the type of capital efficiency I'm looking for. So it's not just top line growth, it's top line and bottom line growth. Top line growth is very important, but not at the expense forever of bottom line growth. And you're seeing the companies that are raising the most capital now, maybe except some of those top AI companies, it's not just top line growth. It's also the unit economics have got to work. You've got to make money on every transaction that one day they can see you being break even or or cash flow positive. I think the fourth one is a very clear go-to-market strategy. So I want to understand how you're going to market. Are you going through distribution? You know, something when I was in Silicon Valley, I learned from one of the experts there. He said, first-time entrepreneurs focus on product, and second and third-time entrepreneurs focus on distribution. And what I like is that the entrepreneur, whether they're early stage or later stage, they've got distribution channels. That they're not only selling through the direct sales force or indirect sales force, but they're actually selling through distribution channels. One of my companies one of the companies I had in my old Kalon stable, a company called Senmark, which is a cybersecurity company, but the majority of their sales are actually through distribution channels. They're in probably 30 global markets right now, and most of their sales, they do some sales direct, but most of them are actually indirect through distribution. So they leverage off the sales force of the affiliate partner, of the distribution partner, to actually make sales. And I love that model because it's your cost of acquisition goes down because it's not your sales force, and your lifetime value typically goes up because they're really the distribution partners that are selling your technology. They've been working with those customers for years, and they've really got lots of credibility, and the customers don't churn. I think the fourth one for me is a very, very coachable entrepreneurs. I want coachable founders. Founders that are coachable, that are prepared to listen. They take your advice. They take your advice seriously. They listen to you, and they do what's right. Not saying listen to my advice without thinking about it, but at least listen to the advice. Let's debate it, and let's agree on a way forward. Unfortunately, what I found through my days, and I've made a couple of mistakes when I've made investments, is entrepreneurs that were not coachable. They believed they knew it all. They believed they had to know it all. That not knowing it all was a sign of weakness, where not knowing it all is actually a sign of strength. You know, we all as entrepreneurs, I've built many, many companies. I've exited many, many companies. I'm probably on to my over 100th company now that I've helped build. And entrepreneurs that are coachable, the chance of them being successful is so much higher than ones that are non-coachable. And what entrepreneurs don't realize, and I was the same when I was a young entrepreneur, is you don't know what you don't know. You just don't know that. And you don't have to know that. The best leaders and the best entrepreneurs are the ones that are saying to everyone, please help me. I don't know everything. What should I do? Should I go left or should I go right? Maybe left is going to pothole and going right is going to riches. So I like working with those coachable entrepreneurs now. Well, I'll only invest in a coachable entrepreneur. We'll discuss things. I'll listen to my opinion. We'll debate whether we should go forward or not. And then we'll decide collectively what we should do or what we shouldn't do. Then I think the next one is a clear path to, if you're investing in a South African company, whether it's an angel or a venture capital company, I want to see a clear path to regional growth, African growth, or global growth, and preferably both. So right at the outset, when I invest, they must have a clear path that they are going to become a venture capital investable business. You said 10x. You know, what we look for really is 100x, because it's the power law. You know, if you have a clear path to growth, South Africa's not a big enough market in venture capital to get 100xer. You're not going to get that. If you're going to exit to a South African company, you're going to make a nice bit of money, but you're not going to make big money. So I want to make sure those companies can start up in America or Europe or Latin America or Asia, wherever it might be, or even going into Africa where we can actually get a dollar-based exit. So that clear path to regional and global scale, and obviously that's traction, a lot of traction, larger target addressable market. So that's something that's very, very, very important to me. I think the sixth one is, so it's obviously scalability. You know, so I'm talking about the clear path to growth is about scalability. And then communication skills. You know, as an entrepreneur, you've got to sell to investors, you've got to sell to employees, you've got to sell to customers, you've got to sell to the market, you've got to sell all the time. You need to be able to communicate and articulate your value proposition very, very clearly. You know, when someone sits with me for a minute and I do not understand what they do, I'm out. I'm not in. Because they say it takes 7 seconds to get someone's attention. I'm giving them the benefit of the doubt. Give them a minute. But if they can't explain to me what they do, who their customer segments are, what's their unique selling proposition or the unique value proposition, and I don't understand it, well, a customer's not going to understand it either. And that for me is a criteria that communication skills is absolutely fundamental. And often you find these entrepreneurs that are very engineering focused, but they're not necessarily commercially focused, and they don't articulate their value proposition, their business very clearly. And I won't make that investment. So that's a long answer to a short question. But those are the 7 types of things that I look for before I make an investment. And if you've got those 7, there's no guarantees, but I do look for 100x return on capital. And I know I'm not going to get 100x return. If I get a 10x or a 5x, on some of them are fine. Some of them are going to go insolvent. I'm going to get a 0x. And I understand this. That's the nature of risk. And investments in angel, investments in venture capital is about risk capital. I don't want to invest in 10 and 8 go in, but I want to invest in 10 that I make money on 8. But I also understand if I'm going to make 100 extra, it's going to be on 1 or 2. And then I've done very, very well for either myself as an angel or my investors as a venture capitalist.
A lot of these principles are obviously at the early stage startups. And what you find out is that a majority of startups are started by people who either just have an idea for a product but don't really know about how to run a business, right? How do you think founders can be able to get these skills? Do you think that accelerators have a role to play in trying to build, these startups which are going to be investable?
Yeah, I think I'll come back to accelerator now, but I think what I like to invest in is I don't like to invest in individual solo founders, solopreneurs. I'm not mad about that because I think to try and be I believe you need at least 2 people to be the founding team. You need someone that can build the stuff, the engineer, I'm talking about tech now, and someone that can sell the stuff, the commercial stuff. So you need the hacker that can build and the hustler that can sell. So if you are the engineer by yourself, I think what you try and do is try and find a co-founder or try and find a first employee that you give a big slug of equity to that can be that commercial person. Because, the issue with engineers, unfortunately, for one, they might not be good salespeople. More than likely they're not because they love building stuff. They are engineers, but don't take the journey alone. It's very, very hard to take this entrepreneurial journey alone. It's like trying to fight Muhammad Ali with one hand tied behind your back. It's too difficult. And finding it, if you can sell your passion and sell your idea and all the things that I spoke about, you can find a co-founder. They might not be getting 50% of your business, but maybe it's 20, 30% of your business that they are very commercially orientated. They fall in love with what you're doing. They're passionate about what you're doing. They understand what you're doing, and they can be a co-founder. And where can you find them? Yes, you can find them in the accelerators. You can find them at the entrepreneurial events that are taking place every single week all over the country. That's the place I would look for a co-founder and have a co-founder in your camp. Because you want to get my capital as an angel investor, or even as a venture capitalist, I prefer to invest in at least 2 co-founders. 3 is fine, but at least 2, as I said, the hacker and the hustler. Someone that can build it and someone that can sell it. So that's my advice for any entrepreneur that wants to be, that's on their own. Don't try and take that journey alone. It's just too hard.
I'm interested, in the red flags that you kind of try to look at, right? You mentioned that you don't really try to invest in startups with only one founder. Can you just share more on, kind of things that you try to identify in startups before you pause and say, no, I'm not getting into this one?
But I think, I'll talk about my 5 T's here, but I think number 1 is the technology. They need to have a technology that's 10 times better than anything else in the marketplace, So it must be something that's really good. There's very few times you find a technology that no one else has built. Even in the AI space, if you look at the AI space now, every day you read about more AI companies coming out. And they're not, whether it's vibe coding, it's not Replit or it's Lovable or whatever it might be. There are so many companies that are being spawned in a specific area. So, I think that's number 1. The technology's got to be 10 times better than anything else. Number 2, there's got to be traction. So whether it's a small amount of traction, obviously the valuation will be much lower, and it's got all my other criteria that I mentioned, or it's a much larger amount of traction, which will be more a venture capital investable business. This business Sandmark, interesting enough, when Kalon invested in them and I met with them, they were doing something like 10,000 Rand a month. And now I'm not going to mention the number, but they're a multi-million-dollar business now from 10,000 Rand a month. And they had all the other criteria. They were great founders. They were just really together. There were 3 of them as co-founders, and they were just absolutely perfect. There was the commercial guy, the legal, the real leader, and then there was the engineer. So it was a great team. So that's traction. You've got to have a certain amount of traction that I get interested. The 3rd T is around target addressable market. It doesn't help having a target addressable market of 10 customers because you can have 100% and you sort of nothing company. So you must have a reasonable TAM in South Africa. And I want to come back to this. South Africa is a launch pad. It's not a destination. It's great to launch a business in South Africa, build your business where you birth it. It really is. It's got a decent sized economy of $400 billion, decent economy, decent financial services sector, decent infrastructure. Everything's decent about South Africa. Great place to build a company, but not a great place to exit a company. Very few RPOs. There was one RPO recently of Tazi, I think it was called, and the RPO, but very, very few RPOs. There's more trade exits, but if you really want to get 100 extra turn your capital, you have to actually get these businesses started in South Africa as a launch pad, but then they must move to a destination which is in America or anywhere else around the world, or all over the world. Like a number of my businesses are now, they are all over the world because we've got that type of technology. After the third one is they've got to have the tenacity and the resilience not to give up. Because it's hard. It's easy to get out of bed one morning and just say, this is too hard, I'm going back to my corporate job. That you don't want to invest in someone like that. You want to invest in an entrepreneur, and you have to decipher that type of entrepreneur, ask the right questions, that they're really tenacious, they are resilient, they are not stubborn, they are relevant, and they know what they want to do, and they've got a passion, they've got a vision, they've got a mission, and they want to achieve that. There's a much bigger purpose than just making money. Because making money is a byproduct of the success that I talk about. And the last one is the trenches. They must have something between like a 12 and 18 month moat around the castle. So if someone else just starts copying them, it'll take them 18 months to catch up, but the business is 18 months ahead the whole time. So they're always ahead of the competition. So those are the 5 keys that I talk about that I would look for before I make an investment in an entrepreneur.
While still on that, let's talk more on what is really like an uncomfortable conversation for most of the early stage founders, right? And that's the ownership, right? So at the beginning, you have an idea, you have a friend who is coming in, you're like, as the engineer, you raise a couple of the seed funding, etc., etc. But then because, like a founder does not really know much about how to like align the equity with the future growth of the company, when a VC comes in, the cap table is a mess now, right? Can you just share more on what a founder has to think about when they're starting off and they are kind of like allocating the equity to either co-founder or the angel investors?
So I think, as an investor, I would like to see, if I'm coming in at a seed round, which I've just made a number of angel investments or seed investments recently, I'd love to see the entrepreneurs, not entrepreneur, but the founding team owning 80, 90% of the company, the majority of the company. Because typically what you find is seed, you'll dilute by 20%. Pre-Series A, 20%. Series B, 20%. So when you finally get to Series C or an IPO, you must still have 20, 30% of the company. You can't give away too much. And I see too often some of these entrepreneurs give away too much money for their early stage investors. They give away more than 50%. And what they've basically done is make themselves uninvestable. So, if you really want to get how much should be allocated to founders or co-founders or other people, I would Google it or go to any of these large language models, and I'll give you a very clear answer. But my answer really is, if it's a co-founder, max is obviously 50% if you co-found the business together. But if you find them, maybe 20%, maybe 30%. It depends on their role. Are they full-time? It depends on all those things. And then maybe your first hire, which might be your marketing director or your sales director or something like it, maybe it's 5%. That's the third hire in the company. And then it goes down from there. It goes to 1%, 0.5%, 0.1%. So when you've got 100 people, you have a 10% or 20% ESOP, employer share option program. And you'll be issuing these shares to employees that are performing. And that ESOP will be every time a new investor comes in for every round, they will probably ask for another 10% ESOP. So the ESOP will be diluted from the founders and the other players, not so the new players or the new employees can have a share in the company. I'm a firm believer in everyone having a stake in a company, however small it might be. Just a little anecdote. I read this morning, it's quite fascinating. NVIDIA has got something like 33,000 employees, or this article was written a week or 2 weeks ago. And because it's gone absolutely ballistic, the share price, and it's, a multi-trillion-dollar valuation. Of the 33,000, 27,000 of them, through their ESOPs, through their share options, are millionaires. And 50% of them are $25 million heirs. That's just in NVIDIA. Now, that can happen. It can happen in a company where you list, and then you just go, they're in the right place, the right time, with AI and with all the chips that they require. I mean, it's incredible to have half of the employees are greater than $25 million. So it just shows you they are owners of this company. They're not going to walk out the company because they're owners of this company. And then you need to have vesting. You don't just give employees shares. They vest over a number of years. So even if you bring in a co-founder with you, they vest. They'll vest over 4 to 5 years. So every year they'll invest, for the first year they'll invest 25% of what they've got. And then every month for the next 36, 48 months, they'll invest 1/36 or 1/48 till they get that equity. What you have to watch, and I've seen it, it's very dangerous, is a co-founder, you give them 20, 30% or 50%, and they walk out the door, and there's no vesting schedule, and they've taken half your business. You're finished, because you'll never get a cent of an investor after that. So you have to be very, very careful that you're vesting. When I make an investment, not as an angel, but as a venture capitalist, we make sure the founders reinvest their equity. Now, they might have been building this company for 5 years and they own this company, but we invest in them. We say, okay, we'll give you 1 year credit. So 1 or 5 years, and the next 4 years you have to reinvest that equity unless you IPO or you sell. Then it'll be what we call 1 trigger acceleration or 2 trigger acceleration. We'll let them get their full share, or if they have to go on an earnout, there'll be a two-sector trigger. That's how you have to work. And my strong lesson here to everyone on this call, please, if you are giving some equity away, make it vest over 4 to 5 years. 4 is probably the standard. I'm seeing 5. Someone's even seeing more. But don't just give the equity away, because then there's absolutely nothing holding your people back. And ultimately, you'll be destroying your future and your ability to raise capital down the line.
In terms of the cliff, I mean, if you have co-founder, right, and then the equity, is vesting over a period of 4 years and they leave after, say, for example, a year, I'm assuming that's not really a positive thing. In terms of the cliff, how should founder try to think about how long do you want to retain, a critical hire before they can be able to leave with the equity that is done the vesting?
There's a lot of clauses there, Brian. I mean, there's good levers and bad levers, but let's assume it's a good lever. So there's nothing fraudulent or there's nothing makes them a bad lever, bad performer, or whatever it might be. But if it's a good lever, typically there'll be a cliff after 12 months and they will get a quarter or they'll get 25% or 20% of whatever shares that you allocate them. So if you allocate them 10%, at the cliff after 12 months, they would get either 2%, which would be a 5-year vesting, or 2.5%, which would be a 4-year vesting. And they own those shares. So they can take those shares, they own those shares, and they can sell those shares and they can do whatever they like with those shares. When you exit the company or you raise the next round of capital, they might sell them as secondary capital or hold on to them until you exit one day to make a larger return on the investment. And then after that, if it's 4 years or 3 years, it'll be 136 every month. So every month they get 136 of their equity. That'll be a 4-year vesting, 1 year and 3 years, or 1/48, which would be a 1 year and 4 years, which would be a 5-year vesting. So you have to be very careful and very clear about that. If they're a bad leaver, however, and they left because of performance problems and they left because of, they dipped their hand in the till or whatever it might have been, well, then there's typically in your shareholders agreement, there'll be a bad leaver clause, which you can buy back their shares at a very, very nominal low price because they're a bad leaver. So you have to define this very clearly. Everyone has to define this in their either MOI or shareholders agreement. And typically I would want it in a shareholders agreement where that defines the terms between all the shareholders, including myself, all the staff and the founders. So it's defined in the shareholders agreement exactly a good leaver or a bad leaver, what would happen in their shares. But it can't be silent, because if it's silent, they'll own those shares. It has to be very clear in the shareholders agreement exactly what happens under a good leaver or a bad leaver.
Another thing that I want to get your insights on, right? Which type of business would you say is more aligned with what you would be able to invest in? Is it, like a B2C? Is it like a B2B? Is it like an enterprise? Or is it like a government kind of, business? What kind of business do you lean towards in your investing?
Yeah, that's a great question. So let me go to B2C first. So business to consumer, I've invested and built quite a few B2C businesses. They are very, very expensive to build because it takes a lot of marketing dollars. When you're building a B2C, you're selling to the consumer or prosumer, whatever it might be. Take OpenAI, it's a typical consumer and business-to-business type of business. And it's very, very hard to build a business-to-consumer business, particularly in South Africa. We just don't have a big enough market. When you've got 400 million or 350 million people in America, or you've got 1.5 billion people in India, that's a good market for a business-to-consumer business. So I'm not mad about it. I don't invest my angel money or my seed money in business-to-consumer just because it's very, very expensive to get it off the ground. Most of my experience, probably 90 of over my 100 companies, is business-to-business enterprise, whether it's a marketplace, whether it's a SaaS business, whether it's an AI business, whatever it might be, but the customers are the big enterprises. They can pay 50,000, 100,000, R1 million a month for the services. So yes, it's a long deal pipeline, but that's the businesses I like to invest in. So let me give you examples of 2 businesses I've invested in the last 12 to 18 months. One is called, and it's a pun for these businesses, but one is called Envia, which is a legal tech business. So basically what it does is, instead of having a lawyer draw up all your legal documents, there's businesses in America called Harvey, and there's one in Scandinavia called Lagoria, and they both raised hundreds and hundreds of millions of dollars. So I came in very, very early on Envia. They hardly did any revenue. And we're getting clients. We've closed unbelievable clients in the last 6 months to 9 months. It's unbelievable. I don't want to mention them on this call because it's still confidential. And we're raising our first round of capital now. But this is business to business. We are closing blue chip clients. A phenomenal, again, a 2-man founding team, fantastic engineer and a fantastic entrepreneur, commercial guy, a brilliant salesperson. And what's interesting about this guy, they got 50-50 in the business, but the tech guy is still employed at one of the big financial services companies and will leave them as soon as we raise our first round of capital now, which we're raising 10 million. He'll leave the corporate and he'll join the other founder on a full-time basis. But this is via business to business. I've got lots of contacts. I can open most doors in South Africa from my 28 years at Accenture and internationally as well. But again, this is a business that domestic market's going to be too small to build a $100 million business, so a unicorn. We're going to build this maybe to 50 to 100 million rand, and then we're going to go to the global market where we can get those venture capital outcomes and the outcomes that all of us want. I want the 100x, and both the two founders want the 100x, and the new investors are going to want the 100x. And that's an investment I made recently. Another one I made recently was called Higher Sales. It's a double-sided marketplace, and one of the big problems that you got in startups, in corporates, is finding top A-plus quality sales talent. We can find engineers, we can find customer service, we can find all sorts of other things we can find, but what we can't find is outstanding account executive, outstanding SDRs, BDRs, sales operations. And this business is about finding. We have a two-sided marketplace. We have, as an example, Yoko is one of our clients, and we find the best talent in South Africa or even wherever it might be, and then Yoko goes and hires that best talent. It saves them a fortune of time, and they don't have necessarily the context or the expertise to find this top sales talent. So that's another business I've invested in, but it's completely enterprise, business to business. But we sell to startups and we sell to the big corporates. But it's taken off as well. And we've got hundreds and hundreds and hundreds of suppliers. So we've got hundreds of great people on our platform. We've used LinkedIn and some other tools to attract them. And then we've got many, many clients on the other side that are actually the demand side, which are actually buying these salespeople. And we make like a normal recruiting company, we make a 15% return on every single person. So that's just two of my 11 businesses, and they're doing phenomenally. Actually, another business I'll mention is Ollie, which is a mental health business, which is a health tech business. They're a much later stage business than the first two. But again, they're enterprise businesses. We've got some unbelievable blue chip clients. We're just about to close a deal with one of the top biggest hospital groups in South Africa for an investment into them, which will, I'm sure, take this business to another level. But we have focused absolutely on the enterprise. We don't focus on the end consumer because, as I said, it's just too expensive. So we have system development reps, SDRs, that will do inbound and outbound, or outbound and if we get inbound, and then they'll hand it over to an account executive that will meet the client, go and do the pitch, and hopefully go and do the close. And that's how we set up our sales organizations for my client, for my investing companies.
It appears to me, Clive, that in terms of the deal flow, you have a lot of startups. How do you identify them? Is it more pitch decks that you get from them? Or is it more, you knowing where to look at, like in terms of people who are building like truly amazing technology products?
Yeah, it's actually a combination of both. There's a lot of inbound stuff where people just cold call me. I've got 35,000 followers on LinkedIn. I'm sure you've seen I do a lot of LinkedIn posts. So from those posts, I get a lot of people coming and say, I've got this great business. Can I chat to you? And I'll say, absolutely. Send me a pitch deck. If the pitch deck is exciting for me, I'll set up a meeting. My first meeting will probably be a Zoom call. If I like it, my second meeting will be over coffee. So I can actually meet the entrepreneurs directly. And the other way is outbound. Sometimes I just read about great businesses. I read about they won a competition or whatever it might be. And I'll contact them and say, I'm really keen to put in a check into your business. I'd love to become an investor and take it from there. So it's both. They're coming to me cold, they're coming to me warm, and a lot of them also is from my network. I've got a big network, and a lot of them from my network introduced me to these businesses, saying, Clive, I know what you've done. I know you're an entrepreneur, you know tech, and I've got a great business. In fact, Envia came to me that way through an Accenture colleague. He saw this business, he was involved in this business, said, Clive will be wonderful for your business. And he introduced me to them, and that's how I got involved in that Envia business. Higher Sales, as an example, I got involved through my LinkedIn connections. Ollie, I got involved through my LinkedIn connections. So it really does depend. With so many connections I've got, and I reach so many thousands of people with my posts, I get an unbelievable amount of deal flow. But I'm investing in 1 in 50, 1 in 100. You're not investing in more than that, because that's the odds. It's 1 in 50, maybe in angel, 1 in 100 in VC. And that's typically what you find around the world.
Over the course of the last, I would say 2 to 3 years, we have seen a downturn in the amount of the VC capital that's coming in for startups. Before I proceed to how has it been for you as an investor to raise capital from the LPs, I want to know how has this changed the quality of the startups that you see, right? How do you think the lack of capital has really changed the quality of the deal flow that you have seen over the last few years?
But if I look at South Africa, it's quite interesting because, let me go to Africa for a second. So there's definitely something that hasn't really happened in the last few years. It's been debt funding or revenue-based funding. So debt funding and revenue-based funding has become a very viable model of raising capital, and it's non-dilutive. So you don't give shares away. It's just debt funding. Look at Kenya. Kenya got in 2025, I think it was, they got something like $1.2, $1.3 billion of investment, but about 50% of that was equity financing and 50% of that was debt financing. So South Africa is still quite small in debt. I think of the funding we got last year, a few $100 million, $500 million, whatever it was, about 50, 60, 70 million of that was debt funding. So it is still quite small. But on the equity funding, where we have a problem, we have a problem at the angel stage and the seed stage. We don't have enough capital at that stage. And that is really impacting our ability to grow these big companies. So you either have to bootstrap those companies or find someone like myself or someone that's been successful in business that'll put that initial 1-2 million rand check into you, so at least it can buy you 12 months of runway that you can get your next step, that you can go and raise a bigger round of capital. But that's where we really are short of capital, is the early stage. And I really wish, I read about the pension funds, and some of them have put a little bit of money into venture capital and stuff like that. But if pension funds in this country could just put 1% of their fund into early stage financing, you can just imagine what they would do for the economy, for the GDP, etc. Because those businesses are the ones that actually need the capital. So yes, there is less capital because there's definitely less capital at the angel stage, and even at the Series A stage, the growth capital stage, there is less capital exists. But the founders are very selective with who they invest in. Bad unit economics don't survive. They're not going to invest in you. So what you're finding, and you're finding this all over the world, is you're finding less investments but much bigger checks. And you're finding that in South Africa, and you're finding that all over the world. For the true businesses that have achieved all those things I spoke about earlier, they've got good unit economics, they've got capital efficient businesses, great founders, etc., etc. There'll be, as I said, less investments but bigger check sizes into those companies. So that's how those companies need to raise capital. Traction solves the problem. The problem that we have in South Africa is not the capital. We've actually got the capital. I'm not saying it's enough capital, but there is capital. Where we have a problem in South Africa is exits. We don't have enough exits. They did go up in 2025. There were quite a few trade exits. There was one IPO, but we don't have enough exits because the exits would what you do with an exit, you take that capital and you infuse it back into the ecosystem that you can make more and more investments. And we don't have enough of those exits yet in South Africa. That's why it's so important. And I know with all my businesses, I want them to go offshore. If it's in the United States, I want them to domicile in Delaware, domicile the IP in Delaware, so we can get the exit in dollars, euros, or pounds, because at least then we can play it forward. The investors got more money to invest in more companies. These entrepreneurs become investors and they can play it forward. So it's a self-fulfilling prophecy. But yes, less number of companies are invested in, but bigger check sizes for the great companies. And that's and seed stage is really, really hard. It's not Series A. Later stage capital once you've got traction, the investors will find you with later stage capital, once you've got that traction. But the early stage is difficult.
Yeah.
Very, very difficult.
Before I jump onto the exits, right, is there like a particular reason why a lot of the pensions, like in other platforms, don't really see VC as an asset class they can try to bet on?
But I think it comes back to South Africa. We're maturing now, so I think you're going to see more of that. And I really am holding thumbs. We're going to see more capital flowing into the right venture capitalists and institutional investors that they can invest in these early stage and even their Series A later stage startups. So I'm really optimistic that will happen. I don't think it's happened in South Africa just because we're a very immature cottage industry. So I don't think the pension funds were ready for the risk of venture capital. It is a risky asset class. They want to put their money into big private equity deals where they've got a big asset base, and the risk for them is very, very small. But the risk in VC is big, it's large, but your outcome's also very large. So if you get it right, you can give them 100 times return on capital, 10 times return on capital, 5 times return on capital, which they won't get in their typical traditional private equity type or listed equity type of environments. So I'm really optimistic this will change. And I know there's a lot of people in South Africa that are speaking to the right people about putting more money into the ecosystem. And I really hope it's not just for later stage investments, but it's for early stage investments as well. I mean, the government's got a lot of money, but I think you need to have the right people that can deploy that capital, because not just capital these entrepreneurs need. They need mentorship. They need smart capital. They need capital that's going to help them. Like what I do is I get very, very involved in my businesses. I'm on the phone to them literally. If it's not every 2 or 3 days, it's every day. I'm on the phone to them. And talking about our strategy, talking about new clients, talking about what we're doing, talking about where our next growth is coming from. So because I've had so much experience, we need more of those people who are getting more and more experience in South Africa now to get into venture capital, that they've exited their businesses and they can start really helping the next generation of entrepreneurs build their businesses. So that's critical. And that's why I think the pension funds over time, or more money from the institutions, needs to go into this asset class, because we have so many great ideas. I tell you, the great, brilliant minds we've got in this country. If I look at Cape Town, we've got this innovative ideas. Joburg, we've got this access to the big corporates, and we've got access to trade exits. But we've got a great community here in South Africa to get a business going. Brilliant, brilliant entrepreneurs, but they struggle to raise capital. And that's why a lot of them try and go offshore too quickly, and they struggle to raise money offshore too quickly, because in all honesty, they haven't got the track record. And in South Africa, because it's such a good playground, as I said earlier, it's a great country to prove your concept that it actually works. And then you can take it globally and you can actually raise your next round of capital globally.
You brought up a really interesting topic, right? And that's the difference between trying to raise from like an external investor compared to trying to raise, within the country, right? What do you think is the main advantages and the disadvantages of trying to raise from, like an external investor and a local investor?
Well, I think, the point I was raising there earlier is that you need smart capital. You need capital that's going to help you open up doors and it's going to help you get your first 10, 20, 30, 50, 100 clients. Now, in all honesty, if you're an international investor and you don't have access to these clients in South Africa, you're not going to be very helpful, in all honesty. Yes, you might be able to access capital, but you can't access customer. So if you come to a local investor for your first 10, 20, 30, 40, 50 customers, they'll be able to help you open those doors. They've got contacts. They know the people. They play golf on the weekends with them. They socialize with them. That's, to me, why it's such a big advantage. If you're a South African company, to raise from your first round, your early stage rounds, from a South African investor. Once you've proven yourself in South Africa and you've got product market fit, and now you just need to get more capital that you can pour this capital on, like putting the gas in your car, and you put your foot in the accelerator, and you've got a repeatable and scalable and profitable sales model. You've got product market fit. Yes, then you can go for global capital, because that's growth capital. You put $1, you get the 5-10 out, as I was saying earlier. It's not that early stage capital where you're still looking for product market fit. You're still looking for the product. You're still looking for, founder market fit. It's difficult. And that's easier to get it from South Africa, because they can help you get to product market fit. They can help you get to that 10, 20, 50, 100 million rand business before you have to go take it overseas and go and raise a big round of capital. So that's why if you've got your uncle in Los Angeles and you're going to move to Los Angeles to go and start your business, you should try that. There's nothing wrong with doing that. But there's so many businesses in America. It's so competitive that it's a lot easier getting a startup off the ground in South Africa than it is getting a startup off the ground in America. One of my companies that I invest in won the South African Entrepreneur of the Year award, and one of the prizes of that was to go to Silicon Valley and present to a whole lot of investors. And it was most interesting. There were probably 100 startups there pitching to 500 investors. And this guy, the South African, just told me all the other companies were doing $5, $10, $20 million. We had 100,000 rand per month. We just couldn't compete with those guys overseas. So that company can lease. It's a good company. They can raise in South Africa. Let's get to $1 million in annual recurring revenue. And at that stage, when we're at $1 million or $2 million, that's the time to go overseas, because that's sort of what they look at, $1 million to $2 million ARR. If you've grown fast enough and at least double digit month on month, you might get a reasonable sized check overseas. Remembering the money, what's good about South African entrepreneurs, South African entrepreneurs have done well with the limited capital available in South Africa. So we're very constrained in capital. So they are more capital efficient. Where if you look at an American business, it raises 5, 10, 20, 50, $100 million. They're not capital efficient. They don't have to be, because they've got so much capital. Where you're putting in 5, 10 million rand here, the people have to be very, very constrained and very capital efficient. And that's how we grow very disciplined businesses in South Africa that can actually scale around the globe if they know how to go and raise capital from around the globe.
I'm going to jump down into the exits. I mean, that's the whole point of the VC, investment. If you invest in a company, at pre-seed or at the angel stage, eventually you want to get a return on investment in an exit, right? How do you think the secondary market is in South Africa at the moment?
Yeah, I think it's pretty good. I think it's, I know I'm in a situation now. I've got two companies where I've got my shares up in the secondary market. I'll make a pretty good return on my capital. But I don't want to take the whole journey. I'd rather take that money and reinvest it back into new startups. But I think the secondary market is a lot more mature than it used to be. I mean, a lot of early stage investors like angel or seed investors or pre-seed investors, you get to the Series A, they help the businesses, and then it's a 10, 20x return on capital, 50x return on capital, and they'll walk, move away from the business. And it's actually good for the business because there's not too many people on your cap table. So everyone wins in the secondary market. So that is definitely an exit way of exiting, and a very popular way of exiting in South Africa is in the secondary market. But our challenge, if I look at from a macro point of view, our challenge isn't deal flow. It's actually capital going back into the ecosystem. That comes from exits. So the biggest downside of what we've got is exits, and we need more. As I said earlier, we need more exits, and if we can just get that right, you'll see a lot more capital going into South Africa and a lot more startups being funded.
If you look at the acquisitions, I mean, if you look at, the market, in South Africa and you compare it to the rest of Africa, I think Mzansi is way up there, right? But as you say, it's still not enough. How does the ecosystem change that? How do you encourage your founders to build a business that's going to be bought by either a listed company? How do you install that kind of mentality in the founder to say, you are building this to exit, right? You're not just building it for the next 20 years.
I don't think I do much encouragement, because I think most founders I find that actually want to exit. They want to create generational wealth for their family. They want to work for 10 years really, really hard and give it all, or 15 years, whatever it might be, and then go build a global business. And at some stage, when it makes sense, they want to exit at least a portion of their shares or a full exit of their shares. So that's the majority of startups that I speak to want that. I mean, there are people that want to create generational, hand it over to my family type of businesses, and there's nothing wrong with that. But as a venture capitalist, that's not what I'm investing in. I'm not investing in a company that doesn't want to get an exit, because that's not what venture capital does. So one of the first questions I want to understand, so what's your vision for this company down the line? I don't want them chasing an exit from day one, because that's not the thing. Companies are bought, not sold. But the point is, at some stage, you want them to exit so they can create generational wealth, they can start their next company, etc. So there's not much convincing to do. 99% of the companies I speak to, they want to create an exit and create that wealth for their family. So, yeah, and it makes absolute sense. Money is a byproduct of success. So they focus on execution, not the idea. They focus on doing well. They focus on capital efficiency. They focus on the right unit economics. Get all that stuff right and do the right execution. The exit will follow. It'll come, maybe in 5 or 10 or 15 years, but it will be there at the end of the day.
From the acquisitions now, to the public markets, IPOs, right? I don't think we have seen a startup that started, from an angel fund go all the way to the JSE in a while, right? What do you think it takes, to build a business that's going to be able to list?
So look, there was a business called Optasia that listed about 2-3 months ago. So I think I'm not sure where they started out and where the capital came from, but there were some angel investors, early stage investors, and they IPO'd 3, 4, 5 months ago. But that's one in, you don't find many of these happening in South Africa. One happened last year. What you did find in South Africa a lot last year, like Nedbank's acquisition of Coco, Bank Zero's acquisition, Stitch's acquisition of XePay, Walletdock's acquisition of Capitec. I think Herex merged with a company in America a year ago. So there were quite a few good trade exits, but they weren't $100 million, $200 million exits. They were maybe $10, $20 million exits, because they were South African exits. Most of them were South African exits. Optasia, I think, was a good exit because it was an IPO and the share price went up. But there are definitely a lot more corporates that are looking to buy technology rather than build technology. So take Capitec buying Walletdock. Walletdock, a really good payments company. Capitec didn't want to buy and build that sort of technology. And Walletdock had, many, many, many clients. So they got those clients by buying Walletdock. They paid a few $100 million for the company, and they got a great company, great founders. I know the guys, and they really are a great company. So these exits, these local exits, are definitely happening more often now. But as I said, they're not going to create that $100, $200 million wealth that can be created if you get your business offshore. You're just not going to get that. I mean, our corporate got, I think, 1.5 billion rand from Nedbank, something around there, and that's public information. But that's, if you look at that, God, that's not even a $100 million exit. It's an $80 million exit. Not a huge exit. Compared to that, could have been a $200-300 million exit overseas.
In terms of the VC environment, one of the things that's like really important for an investor, if you're going to be like invest, is the moat, right? Because you don't want to invest in a startup that's going to be having like a competitor, like a year into launching, right? In terms of AI, how do you think it has impacted the ability of startups to have a moat? I mean, right now, even like a person who doesn't have like an engineering kind of a background can go to Lovable and be able to build an MVP of an idea they have, right? How do you think AI has impacted ability of startups to have a moat that you as an investor can look at and say, okay, I can be able to invest in the startup because the moat is really strong?
No, I think, the mood is strong, but I think you have to be very, very careful when you invest in AI. Out of my 11 investment, about 7 of them are AI companies. But what I see a lot of, is just AI wrappers. So what you see, they even call it an AI company, but all it does is creates a nice user interface around ChatGPT. And that's not an AI company. That's just a UI, it's it would be called a wrapper around AI. And so people, I saw an education one the other day where all the education, you could go into this thing, you could ask them about science and maths, and all it really was just a graphical user interface that was going into ChatGPT. All the answers came from ChatGPT, and they couldn't understand why I wasn't interested. But if I look at Ollie Health as an example, that is an AR business. It is a deep tech AR business. It's an AR first business. If I look at Envia, which is the legal tech company, it's an AR first legal tech company. If I look at Higher Sales, it's an AR first higher sales recruiting platform company. And that's why we've invested in those companies, because they're not that easy to copy. You can't just take a Replit or Lovable or something like that and just copy that sort of tech. I mean, those techs are getting better. Maybe you can get 80%, 90%. They are getting better over time. A couple of years ago, they really weren't. But they're getting better every single day. But there's so many AI businesses being built that you have to really know what problem is being solved. How big is the marketplace? Have they got some traction? Are they solving a real problem? Are they generating a high ROI? Because if you look at the AI world right now, Efrain, they say about 90% of AI projects are not delivering an ROI. They're still in pilot phase. They're not even actually rolled out to the full organization. So if you look at, a company like McKinsey as an example, I was ex-Accenture. But even Accenture just trained 500,000 people into AI. And the people that said they couldn't be trained in AI, all couldn't be trained in AI, have left the company. Simple. Because the AI world is changing everything. McKinsey CEO, I read an article of his the other day. He said they got 65,000 people in McKinsey. Of those 65, 25,000 of them are agentic AI and 40,000 of them are human beings. So, that's the way the world is changing. The consulting business is changing. Business out there is changing. But the opportunities with AI in the corporate world, in the enterprise world, the business world, I think are better now than they've ever been. And even if it's Lovable or Replit or something, you still need good guys that understand the stuff. You can't just build the stuff. You have to maintain the stuff. You can't just build it and walk away from it and think it's going to last forever. You can't just build an Uber off Replit. Yes, maybe it can build 50, 60% of the code, but it's not going to build 100% of the code. So, I'm very apprehensive when I see a founder that's got no technical background builds something using vibe coding, because building it is one thing. I've built lots of vibe coding things, but who's going to maintain the thing? Who's going to change it? Who's going to modify it? Who's going to do it when a client complains that it's not working? So I think it's very, very important that we understand and I understand AI very well, because that's why I'm investing in these businesses. My background of computer science and everything like that. But an AI business is a human in the loop business. You can't just leave AI alone. If you want an AI marketing business, the sales SDRs, you want to automate using AI, outbound or inbound or outbound sales. You've got to help train up that AI. You can't just leave that AI by itself. You've got to spend an hour with that AI every single day, checking what the answers are. One of the businesses, not some entrepreneur I spoke the other day, is generating something like 1,000 emails a day using AI. I said, and he said he's getting absolutely no response, nothing. Or maybe he's getting 0.5%. I said, are you checking those emails? Who are you even sending them to? Why don't you rather focus on quality than focus on quantity? Send 20 a day, send 30 a day, but get the AI to write it. You go in there, fix it up correctly, and then send it to the client. Make it so customizable that when the client receives it, they absolutely love you and they know you and they trust you. Not because they can all read, they can see that this is just an AI-generated email. Clients are not stupid. I can tell that it's a ChatGPT or a Claude or Perplexity generated content, whatever it might be. So AI I strongly believe in AI. That's why I've made so many investments in AI. But at the same time, everyone talking about AI doesn't mean they got AI.
Yeah.
You want AI first businesses, not you're a CRM and suddenly you just plug AI into your CRM. That doesn't make you an AI business. You're still a CRM business.
As a closing question, right? We have talked right from the beginning of at the angel stage to the exits to the everything, right? What do you think is the future of VC in South Africa?
I'm very optimistic about VC in South Africa because I think you'll see that because all that riffraff is gone, the great VCs are still out there and they're getting exits and they understand how to build companies to get exits. So I just see this getting stronger and stronger and stronger. I think where I'm not seeing stronger now, that's where I wish the pension funds or someone would come in, is at that early stage, at angel seed stage. I'd love to see more capital going into that stage. But the later stage, the VC is maturing rapidly. Exits are maturing. More capital flowing back into the economy. More capital flowing back into the entrepreneurs, back into the VCs. So there's a fewer VCs, but they are mature. They are good VCs. And the ones that are out there now, I think are going to be doing exceptionally well in South Africa.
Clive, I really, really appreciate your time so much. And I wish you all the best in the future.
No, thanks very much. And have a wonderful weekend. All the best.
All right, cheers.
Cheers, man. Okay, bye.
And to everyone, that was Clive Butkow, a venture capitalist and ecosystem builder. If you really enjoyed this episode, don't forget to subscribe to the newsletter and the podcast and share it with a person who you think would find value in everything that we discussed on today's episode. Until the next one, really appreciate your time and have a great one. Cheers.